A very good morning, friends. So I hope your preparation is going good. So we got a very interesting standard today. I would say on the face of it, it's a disclosure standard, but I think it contains a lot of competition as well. Because whenever we think of accounting standards, what comes to the mind is that we're looking at standards which contains accounting. But nonetheless, we've got certain standards as well where there is no accounting, but it involves disclosure. And we're talking of India's 33, that is EPS, earning per share. Now, when we look at the concept of earning per share, I think at the per se, what I'm going to do, I think let me also give my strategy, as I begin with the standard today. We're going to make some revision of the concepts as well, not only just do questions. So we'll first, walk through a little concept and then we'll start doing questions as well. I have selected almost like 15 questions on the EPS. Now, as we start with India's 33, that is earning per share, immediately your thoughts would come that there are two types of earning per share. One is called a basic earning per share, and the other one is called a diluted earning per share. So when we're looking at the calculation of a basic EPS, your mind should be first of all clear in terms of what all is taken in the calculation of a basic EPS. Certain special issues pertaining to the basic EPS, like for example, a bonus issue, like for example, a right issue. And there are a couple of more issues also. For example, we've got compulsory convertible debenture. For example, we need to consider how would you treat a compound financial instrument for the purpose of basic earning per share. And then comes the concept of a diluted earning per share. So as I said, what we're going to do, instead of directly attacking the questions, we're going to first of all make a quick revisions of the concepts related to each and every elements we're going to discuss, and then we're going to start doing questions with you. So let me share the screen, and I guess let me start the inputs in terms of, first of all, just quickly revising a few concepts relating to the concept of a basic EPS. Now, I guess the first thing what should come to your mind is when you look at the earning per share. When you're looking at the earning per share, the first thing which should always be at the back of the mind is that, when you're looking at an EPS, it could be positive or it could be negative. That nevertheless doesn't make a difference because EPS is required to be disclosed by every company, irrespective the earning per share is positive or negative. Because when you look at the word earning, what comes to the mind is that earning should mean a positive one. But of course, we need to disclose in EPS whether it is positive or negative in nature. The second thing which comes to the mind is when you present the earning per share, it is presented for the separate financial statements as well as for the consolidated financial statements. Now, it's not that when you present the EPS in the separate financial statements or in the consolidated financial statements, you don't need to present any one of them. They need to be presented separately. And of course, when you present the EPS in a consolidated financial statements, you need to consider the data, you need to consider the net profits based on the consolidated income statement itself. We'll be coming to the calculations of EPS on the consolidated financial statements also later. Then thereafter, once these basic things are done, what comes to the mind is that when you look at EPS, there are two kinds of EPS we can say. One is there is a basic EPS. Second is there is a diluted earning per share. So these are the two earning per share, and your mind should get tuned in terms of how we are going to make a walkthrough in terms of a basic EPS. So I think in terms of a basic EPS, your mind should work in terms of issues related to numerator, issues related to denominator, and any kind of special issues, as I said, CCD, or as I said, a case of a compound financial instrument. So we'll make a walkthrough on these one by one. So let's not talk of diluted EPS. I think let's first of all make a little walkthrough in terms of the fundamentals related to basic earning per share. Now, when you look at the basic earning per share, the first thing what should come to your mind is that what is the formula in terms of calculating a basic EPS? You can say it is net profit. It is net profit, or we can say loss, which is attributable, to equity shareholders of the entity. So your mind should immediately tell you that we're looking in terms of, you can say, the net profit or loss, which is attributable to the equity shareholders of the entity. And this is going to be divided by what we call weighted average. This is divided by weighted average. Weighted average number of equity shares. Weighted average number of equity shares, which is also called veins. In short, we can also call this as veins, weighted average number of equity shares. So the focus is, when you calculate a basic earning per share, your mind should start working in terms of the numerator. What special issues do we need to consider? And your mind should start working on the denominator as well. As I said, we're going to first of all just take a quick recap of the concepts and then start attacking the questions. And this Excel sheet, of course, will be uploaded on the LMS, where you will be able to easily access as well. Now, when I come to the numerator, so the question is, what are the issues related to numerator? Because when you're focusing in terms of the basic earning per share, your focus should come to what are the issues relating to numerator. So I would say, number one, the first thing what should come to your mind is, when you're calculating a basic EPS, we need to consider the profit, or you can say the loss, whatever the case might be. I'm just using the word profit. The profit is after. The profit is supposed to be after the tax expense. I put that in bold. Now, when I say it is after tax expense, your mind should clearly tell you that it is supposed to be after considering both the current tax as well as the deferred tax into account. So when you go to consider the concept of a tax expense, you need to consider both a current tax as well as a deferred tax computed with reference to Ind AS 12. The second concept which should come to your mind is regarding the preference dividend. So the next thing which should come to your mind is regarding the preference dividend. The question arises, do we consider the profits after the preference dividend, or do we consider the profits before the preference dividend? And this all depends upon the nature of the preference share. Is it supposed to be cumulative in nature, or is it supposed to be non-cumulative in nature? I think, let me also put some questions to you, friends. So when you say that it is cumulative preference shares in nature, are you supposed to make a deduction? Are you supposed to make a deduction of the preference dividend? I think let's start asking questions now at this stage. So when you're going to consider the preference dividend and you've got cumulative preference shares, would you make a deduction of the dividend irrespective it is declared by the company or not? Your thoughts? We're looking at the cumulative preference share. So when you're looking at the cumulative preference shares and you said no, well, I guess when you're looking at a cumulative preference share, the company's liability to pay the dividend is not going to lapse. So whether the company makes a declaration of the dividend or not, you need to undoubtedly pay the dividend. So this is always subtracted. So when you're going to look at the cumulative preference shares, we can say in this particular case, it is after deducting. It is after deducting the preference dividend, irrespective. Let me put that very clear. Irrespective, it is declared or not. Irrespective, it is declared or not. Because in terms of cumulative preference shares, your dividends, even if they are not paid in a current year because there are losses, they will be carried forward and paid in the next year. So we need to make a deduction of the preference dividend, irrespective of the company declared it or not. Then comes the next category, and that is non-cumulative preference shares. I think I'm now definitely inclined in terms of asking what is the status as far as the non-cumulative preference is concerned. What do you say? Do we deduct it or do we not deduct it? Or are there any preconditions before we deduct this particular dividend? I think let's put that question, of course. So when you're looking at this, when declared, it is deducted. Absolutely correct. So in terms of the non-cumulative preference shares, we can say it is deducted. It is deducted only if it has been declared. Only if it has been declared by the company. So if the dividend is not declared by the company, we are not going to make a deduction. So I think we are now absolutely clear on two particular agendas relating to the calculation of the numerator. That you need to consider the profit which is post the tax, both the current tax and the deferred tax as per Ind AS 12. Secondly, the status of the preference dividend completely depends upon the nature of the preference share. Is it cumulative or is it non-cumulative in nature? If it is cumulative in nature, we will make a reduction irrespective it has been declared or not. But if it is non-cumulative, it is going to be deducted only if the company declares the dividend. Super. So these are the two main issues which we confront as far as issue relating to numerator is concerned. Now, as far as the CCD and all those things are concerned, we'll, I think, take care of that later. Now, similarly, we also got issues which are related to denominator. The issues which are related to denominator. Now, when you're calculating the weighted average number of equity shares, what we call weights, I would suggest the best thing to do is we'll come to a little more extensive discussion on the concept of denominator. But one thing which we need to keep in mind is I would insist, I would request that when you calculate a weighted average number of equity shares, please follow a certain format. And the format is that I'm going to consider particulars. I'm going to consider the particulars column. I'm going to consider the number of shares. I'm going to consider the period, that is the number of months or the days, whatever the case may be, the number of months it is outstanding. So we need to consider the number of months it has been outstanding. And then we need to get, you can say, the product. Now, the idea of giving you this particular format is that we'll religiously apply this particular format in terms of calculating a weighted average number of shares. What you need to do, if there is any change, if there is any change in the number of shares, you need to split them in terms of block. So when you make this particular chart, you need to be careful that, okay, if there is any change coming in, keep creating the block. And when you consider the number of shares, you need to consider the cumulative number in this particular case. Because we need to see the status, as we keep moving, you need to consider the cumulative number in this particular case. I think that's on the very basic level, just connecting a few dots before we start with some very basic question on this agenda. That was a quick inputs in terms of numerator and denominator. There is more coming in, especially as far as the denominator is concerned. I think, now begin a journey in terms of a question. So let's, I think, have a read in terms of the question number one. Now, I remember this was a very interesting question, and this question came in RTPs in May 2018. And there was a specific reason. Because if you look at the formula which is given in the standard, the text of the standard, it very clearly says profit or loss attributable to, you can say, the parent company's equity shareholder. So, there was a little tendency of confusion when this standard came at the initial end. And therefore, we see this very interesting question in RTP, because I remember there was a very interesting clarification in one of the Indus bulletins as well, elaborating the concept of EPS, that what Indus 33 says in the text. Now, let's, I think, read this input. It says P is a subsidiary company of ABC. It is preparing both separate financial statements and a consolidated financial statements for the year ending 31st March X1. It has got a net profit which is after tax 20 lakhs as per the separate financial statements and 16 lakhs as per the consolidated financial statement. The share capital of P is 2 lakh shares of 10 rupees each. ABC acquired 80% shares of P, and the accountant of P is calculated the basic EPS for the separate financial statements. So what he has done, he's taken the profit as per the consolidated financial statements, because 16 lakhs is the profit which is based on the consolidated financial statements. And what he has done, the company P has got 2 lakh shares. He's taken 80% of the share. So 80% of the shares have been taken, and then the earning per share has been computed. Examine the correctness of the above presentation of the basic EPS. I think it's a damn easy question, but I think I'll still like to ask you, is the calculations done by the accountant correct, or is the calculations incorrect in nature? It's very simple and straight, but I think I'll still like to ask you, is the calculations which are done by the accountant right? He's taken the profits based on the consolidated financial statements, and he's taken the number of shares, which is 80%. And that's right, absolutely incorrect in nature. So we're just going to organize the data. So let's, I think, make the calculations on question one. So in this particular case, we can first of all tell the examiner that the calculations are not correct. So the first thing you can make a mention is regarding the fact that the calculations are not correct. So we can say the computation of basic EPS by the accountant is not correct. So in this particular case, we can show the calculations of the basic EPS, and that is supposed to be, we give the formula to the examiner, net profits attributable to equity shareholders divided by weighted average number of equity shares. So in this particular case, when you take the basic EPS, we're going to consider the profits, that is, I guess, 20 lakhs. So I think let me just come back on the question. So we've given the financial statements. In the separate financial statements, it is 20 lakhs, and the number of shares in this particular case is supposed to be 2 lakhs. And we can get the earning per share, that's 10. Simple, very straight indeed. Wow. That was literally a warm-up exercise, I would say. Okay, so that's pretty simple and straight indeed. Now let's go to the next question. Quite recently, a very simple question was again put across in RTP in May 22. Now let's, I think, read what is the inputs given in the question. It says on 1st April 2000 X1, entity issued a convertible debenture with a face value 1000 maturing on 31st March X11. Now you need to be careful on the dates. It is X01 to X11. That means 10 years later. It says the debentures are convertible. Okay, is it okay for a presentation in the exam? Well, I guess for the previous question, you can also make a little more mention, elaborating the inputs that the company has taken a numerator which is based on the consolidated financial statements, which is not correct. You could just also give the explanation the company has taken 80% of the shares, which is not correct. Otherwise, I think it's a pretty simple and straightforward question indeed. Okay, so we're given the company is issued a convertible debenture and they are going to be converted. It says 10 years later. Then he says the debentures is convertible to ordinary shares of X at a conversion price 50 rupees per share and the interest is payable yearly in cash. Then he says on 1st April X2, 1 year later, to induce the holder to convert the convertible debentures promptly, entity X reduces the conversion price to 40. Earlier, the conversion price was 50, now the conversion price is 40. If the debenture is converted before the 1st of June X2, that is within 60 days, then he says the market price of the ordinary shares are amended at the rate of 80 rupees per share. Then he says, how will the revised terms be accounted for? I think that's a pretty simple and a straightforward question indeed. So I think it makes sense asking you how much the company is going to charge in its income statement. I think I can definitely put that question straight. I don't think so. I need to really work out the calculations also. You can directly let me know what will we do. The conversion price earlier was at the rate of 50 and now the conversion price is at the rate of 40. So your inputs on this case, what is the treatment of the revised terms in this case? Okay, I'm yet to get an answer, but I'm still waiting for the answers on your side. What do you say? What are we supposed to do in this particular case? Considering that, of course, the face value of the convertible debenture is to the extent of 1,000. And if it is to the extent of 1,000, then is there any implications which will follow? I think I'll have to answer that question. Any guesses on that? EIR calculation. No, 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 no. I don't think so. We need any EIR calculations in this particular case. I think it's a straightforward calculation. Let's make a walkthrough with you in this. Can I say earlier we know the face value of the debenture is 1,000. I think I'd just like to quickly work this out. Can I say 1,000 was the face value and we said the conversion price is 50. So that means how many shares will you issue? If you divide 1,000 by 50, you would have given 20 shares against every debenture. Now, considering that you have changed the conversion price to 40 rupees per share, can I say now you're going to issue 25 shares? So can I say earlier you were issuing 20 shares, now you're going to issue 25 shares. So there is an extra 5 shares which is being issued and the market price of the share is 80. Can I say we are going to charge 400 to the profit and loss account? As simple as that. I don't think so. There is any data also which is given on the EIR computation in this particular case. Right, I hope you got the calculations. I'll still, quickly pen this calculations down. So we can say in this particular case, when I'm looking in terms of the extra charge, we can first of all say the face value. We can say the face value of debenture. So I'm just presenting the answer. So we can say in this particular case, the face value of debenture is supposed to be 1,000. And we can say the conversion ratio. The conversion ratio was that we were giving a total of how many shares? I think it was 50. So in P&L for company, it is an expense written off. That's absolutely correct. So we can say the conversion ratio in this particular case was supposed to be 50. So we can say the number of shares to be issued, you can say as was decided originally, that works out at 20. And then we can go further. We can say now the conversion ratio has undergone a change, and that is to the extent of 40. So we can get the number of shares to be issued, as per revised terms. And in this particular case, that works out at 25. So we can work out the additional number of shares, to be issued, and that's going to be 5, which is nothing but 25 minus 20, just presenting the answer. And we're given the market value per share. We also have the market value per share, and that's, I think, to the extent of 80. So we can get the debit to profit and loss account, and this is going to be a total of 400. Wonderful. Okay, so I think that makes it very simple and straight. It's all warm-up exercise. Very simple and straight indeed. I hope you got the inputs on this particular question. Straight and simple. Okay, that's great. Now, I think in numerator, this 400 is deducted. Yes. When you're going to calculate the basic earning per share, you are going to make a reduction of this 400 because of the revised terms. Absolutely correct. Okay, let's, I think, now take it further. Let's go to the next question with you. Now, this is based on completely a denominator. Now, I'm just thinking, before I discuss this particular question number 3, I am also interested in doing a little more interesting discussion with you, giving you a clarity of thought in terms of how we are going to consider. So just giving you a little conceptual clarity as well, how we are going to consider the impact on the numerator is concerned. So let me do one thing. Now, what I'm about to do at this stage might be slightly different as compared to, how you approach the question. Because when I look at the denominator in terms of India's 33, I've got a slightly different technique. Are you willing to take a risk? Because this might be, a slightly different the way you look at a denominator. Can I take the risk of giving you my perception of denominator in the basic EPS? You got to say yes or no. I didn't get any yes on this now. Okay, I think finally I got one vote on that. Okay, that's great. Now, I'll give you how I start looking at a numerator. Well, a denominator. When I look at a denominator, watch this carefully because this is going to help you a lot in terms of the denominator calculation. Because I'm going to merge a little calculations of the bonus and the right issue. We're going to make some quick mind maps on that before we proceed. My mind tells me that there are basically 3 situations. I'll tell you the 3 situations, then I can put across some questions as well. Situation 1, situation 2. So my focus is looking at the denominator of a basic earning per share. I'm going to give you 3 situations, what comes to my mind. Number 1, I look at a denominator with the perception, number 1, there is a change in the denominator. Let's consider increase or decrease, whatever. So let's consider for the time being that there is an increase. I'm saying there is a change in number of shares. And when I say there is a change in number of shares, for the time being, I'm taking, increase just to explain, illustrate the concept. So I say there is a change in the number of shares. Yes. But I'm looking at, is there any impact, I would say, or is there any increase in resources? Is there any increase in the resources or not? Now, when I say there is an increase in resources, my mind is thinking that the company takes money from the shareholder, then there is increase in the resource. Or if the company does not take money from the shareholder, then there is no increase in resource. So I'm now looking at three situations that is there an increase in resource? Yes. And you can say that when I say yes in this case, I'm looking at that there is no favor. There is no favor to the shareholder. The company has got no favor to the shareholder. So you land up issuing the shares, let's say at a market price. The second situation I'm looking at, that is there an increase in resource? And the answer is, let's say, no. So when you say no, that means there is a complete favor. There is a complete favor to the shareholder in this particular case. And the third situation, what I'm looking at is that is there an increase in resources? And I say yes. But in this case, I'm saying that there is a partial favor to the shareholders of the company. Now, you must be thinking, what am I trying to connote with this? But look at the three situations. I'll give you examples and you can decide as well. So we're saying situation one is there is an increase in the number of shares and the company did no favor to the shareholder. So the company resources goes up, you can say, as per the market resource. The second is, in this particular case, the number of shares definitely increases, but there is, you can say, no change in resource because the company is not taking any money from the shareholders and it's a complete favor done. The third situation is the number of share goes up and the resources also increase, but it's more like a disproportionate increase in resources because you're not taking the money from the shareholders at a market value. You may be doing some partial favor to him. Now, I think I've got some quick questions to you. I'm going to give you three inputs. You tell me, is it situation one, is it situation two, or is it situation three? A company makes a bonus issue. Mind it carefully. A company makes a bonus issue. Fit this in terms of situation one or two or three. You need to visualize, is there increase in number? Undoubtedly, yes. But do you think there is a change in resource? You've done any favor, no favor, or a partial favor to the shareholder. So your inputs awaited. When I say there is a bonus issue, which particular situation would you like to put this into? The number goes up, and in this particular case, is the company doing any favor? You give the shares free of cost. You give the shares free of cost. So is there a complete favor to the shareholder? I didn't get any answers on that. Situation one, situation two, or situation three? Any inputs on that, friends? I think that's easy to decide. When a company makes a bonus issue, you give the shares absolutely free of cost to the shareholder. So in this particular case, I would put the bonus issue in this particular case. I hope you got my funda because I think that was a simple question, but I didn't get any answer. As I said, I have a little different way of looking at a denominator. Therefore, I've created three different situations that when a company, in this particular case, does a complete favor, it's a case of bonus issue. Let's give you another example. If there is a right issue, if there is a right issue, would you like to tell me you'll put this in which situation? Remember, the right issue is made generally at a price below the market price of the share. So are you doing some kind of favor to the shareholder or not? Decide, is it situation one, two, or three? And I think I got the correct answer on this. That's right. It is going to be, in this particular case, what? It is going to be the situation number three. Is going to be a situation number three, that there is a partial favor which is done to the shareholder. And if I say that the company makes a fresh issue at a market price, can I undoubtedly say, I'm saying it is at a market price, then I can say it is situation one. I know, friends, what you're thinking at this stage. So we don't approach the question on a denominator in this front. As I said, I'm taking a little risk and I'm giving you my style in terms of calculating a weighted average number of shares, where I consider that there are three kinds of situations. And accordingly, these three situations will be dealt in a different manner. You need to first of all see in the question, is there increase in number and there is no favor done to the shareholder, like a fresh issue at a market price. The second is there is increase in the number and there is a complete favor done to the shareholder because you don't ask him to pay anything. It's a bonus issue. And there is a third situation, there is an increase in the number. And in this particular case, the favor is done because you would issue the shares below the market price. The right issue price is going to be below the market price. Now, I think let me just quickly give you the inputs on the accounting treatment. How would you treat this in terms of the denominator? Well, let me, I think, ask you questions now because you know this. In any case, because of the difference in the three situations, you will also tackle these three situations differently in the denominator. Can I see if there is a fresh issue? Do you give a weightage to the actual time when the fresh issue is made? Yes or no? If there is a fresh issue at a market price, do you consider the timing factor when the fresh issue is done? Absolutely correct. So I will give due weightage to the fact when the fresh issue was done. Next, if there is a bonus issue, do you give any weightage to the fact when the bonus issue was done? Or do we consider that it is made as if from the beginning of the earliest reporting period? Because in this particular case, there is no change in resources. The company is given the shares at the start. The company's equity did not undergo a change. If the company's equity did not go a change, and that's right, we're going to consider at the beginning of the year. And if it is a case of a right issue, can I say it's a mix of situation one and two? I should split the entire issue in terms of what is the issue for consideration. Take that from the date when the issue is made, and then you should also split the portion which is a bonus element. So I will split. I know you may not be splitting that, but today I'm going to give you a new technique as well. You might love that technique, what I'm going to give you on a right issue. So we can say in terms of accounting treatment, we will give due weightage. We will give due weightage when the issue was made. We'll give a due weightage when the issue was made. And in terms of bonus issue, we will consider as if it was made from the beginning, as if it was made from the beginning of the earliest reporting period, as if it was made from the beginning of the earliest reporting period, which also means that your mind should tell you that we need to do a restated EPS of the last year as well. Because in this particular case, if you're going to consider the impact of this bonus issue as if it is made at the beginning of the earliest reporting period, you report EPS for the current year, you report EPS for the previous year, so you need to restate the EPS of the last year as well. And when it is a case of a right issue, we can say it is a mix of situation 1 and 2. It is a mix of situation 1 and 2, and I will split the portion. I will split the portion between 1 and 2. How will I split this between 1 and 2? That I'll explain in the question. Now let's ask you a quick question again. If it is a mix of situation 1 and 2, is the bonus element involved restating the previous year EPS as well? What do you say? Because it's a mix of situation 1 and 2. So are you going to also make a restatement of the EPS? That's right. So even in this case, a restated earning per share will also be done. Wonderful indeed. Okay, so restated EPS of the last year to the extent of the bonus element will be done. Now what I'm going to do, friends, I am going to concentrate purely on the denominator. We're going to do mix of questions, first on a normal question, then we'll go on to situation 2, we'll go on to situation 3 and learn the art of denominator impact because of these inputs. Let's come back. So now looking at the question number 3. It says following is the data for company XYZ in respect of equity shares during the financial year X1, X2. Find out the number of shares for the calculation of a basic EPS as per Ind AS 33. Now we're given a chart, and in this case we are given that there is an opening balance to the extent of 1 lakh shares. Then there has been an issue of equity share. Then there is a conversion of convertibles into equity. Then there is a buyback of equity shares. And then there is a closing balance which is 2 lakh 5. So this is 1 lakh plus 75, that makes it 175, plus 50, that makes it 225, minus 20, that makes it 2 lakh 5. He's already created the blocks to you. But the interesting part is that we are now given dates which are in between the month. Considering the dates are in between the month, instead of taking the number of months, we're going to consider number of days. I will stick to the format which I gave you in terms of calculating the weighted average. Let's proceed. Question number 3. So we're going to first of all organize the data. So I'm just going to first of all make a chart, make a column for particulars, and let's consider the number of shares, and let's consider the number of days. Let's consider the number of days it is outstanding, and then we can consider the product as well, and then we'll get a weighted average. So go on the flow, pick up the data one by one. First, let's create the block. Now, I want you to give me the first block because I think that's very important and crucial. Undoubtedly, my block will start from the 1st of April, and on 15th June, there has been issue. So would you like to tell me you're going to create the block number 1 from which date to which date? 1st April to 15th June or 1st April to 14th June? I think that is a pertinent question. And that's rightly given, absolutely, 14th June. So let's make the blocks. So we can say it is 1st April to 14th June. That is the date. Let me just shift these columns a bit. So in this particular case, we will consider the number of shares was 1 lakh. So would you like to give me the count, the number of days? Very carefully. 30 days in April, 31 days in May, and 14 days in June. And I think that's rightly given. That works out at a total of 75 days. Beautiful. So that comes to 75 days. Let's go to the next block. The next block is going to start from the 15th of June, and this will go on till which date? So this is 8th November. So we're going to stop till what? 7th of November. So that's right. We're going to consider the input till 7th of November. So let's go till the 7th of November. Let's count the days again. And in this particular case, let me first take the cumulative as well. It works out at a total of 1,75,000. And I guess if you consider the days, I think you've rightly given me. I'll still just quickly work this out. So, by the way, how many days in June? Because that's a tendency where people generally tend to go wrong. So, are you going to consider 15 days in June or are you going to consider 16 days in June? It is including 15th of June. So that's right, 16 days in June, 31 in July, and then 31 in August, and then you can say 30 days in September, and then you've got October, and then you've got another 7 days. That makes it 146. Wonderful, that's rightly given. So that works out at 146 days. We'll take the product later. Now we go to the next flow. And trust me, if you go step by step, you never go wrong. Now, from the 9th of November, we need to go to 21st of February. So 9th of November, we need to go till it is 21st of February. So 21st of February. And let's see the cumulative number of shares. And there is another conversion to the extent of 50,000 shares. So I think that works out at 2,25,000. And that's rightly given. So we get the number of days is 106. I'll still just like to quickly calculate it for the safety of all. So in terms of November, there's going to be how many days? Can I say 22 days in November, 31 days in December, 31 days in January, 21 days in February? I guess you gave me, it's coming to 106. Let's again calculate. From the 8th of, no, oh, sorry, I've written it wrong. My error, my bad. Yes, I've written 9th, it is 8th of November. That's great. So let me just again quickly calculate 29 days. So that would mean you can say 23 days in November, 31 in December, 31 in January, and 21. That's right, 106. Not 104. I guess that comes to 106. So this comes to 106 days. That's right indeed. And then we go further to the next block, and that is going to be 22nd of February till 31st March. So this is going to be 22nd of February, and this goes until 31st of March. And now there has been a reduction in terms of the shares, because in this particular case, I am given there has been a buyback, so reduction of 20,000 shares that works out at 205,000 cumulative in number. And that's right, I think you've given me 38 days. That's right. So we are considering in this case, in terms of February, how many days are we considering? 28. Yes, of course. We're not considering this to be a leap year. So 7 plus another 31, that makes it 38 days. By the way, let me just, I think, quickly add the days as well and see what is the number of days we are getting in this case. It is 365. Is this by chance or is this got to be? The total number of days in the year, of course, is 365. And once you take the total number of days, it should undoubtedly match. And that would indicate you've done it correct. Great. Now let's take the product. So we can take the sum, multiply the number of shares into the number of days. So I think that's where the Excel, does a wonderful job for us. So we multiply this with the things. Oh, error. So in this particular case, multiply this with the number of days. It's coming a huge figure. I think sometimes you can drag this as well and you get the results. Let me just drag it up. That's wonderful indeed. So we get the results out here. Super. Now we can take the sum total of this, and that's going to give you the total. I think you've given me the calculations. Extend the line. That's right. Absolutely. That's the good advantage, when you're using an Excel. So now in this particular case, we can get the weighted average number of equity shares, and that is, I guess, 64, 69, and this is 4 times 0 divided by 365. So maybe I can just get the results directly. This cell, and that's divided by this cell. It's coming to, I think, 177, 232. I think that is the right answer. Great. Super. Okay, so that's right. 177, 233 approximately, rounded off, is the weighted average number of shares. I think so far so good. Isn't the standard very easy indeed? I think yes. You will agree that this is very, very easy standard disclosure computations, but yes, it has got its own kind of challenges as well. We are slowly and steadily moving towards that area. Let's go ahead. Okay, the question number 3 is done. Now comes a little interesting special issue. But I think maybe before this, let's, I think, discuss a bit on the bonus and the right issue. I think bonus is, we'll come back to the question number 4, no worry. But I think I want to first give you the inputs as far as the right issue is concerned. Now, what I'm going to do in terms of the calculation of the right issue might be, slightly different as compared to what you do. Because I'm sure you calculate the adjustment factor. Do you? Or do you manage it without an adjustment factor? Do you calculate a split? I want to know this. Because I'm going to give you my technique of handling the right issue in this particular case. So what do you say? You use the concept of an adjustment factor. I'm going to avoid using the concept of an adjustment factor. Scary sounds. Okay, anyway, I'm going to give you my technique. Enjoy the new technique as well. Okay, let's read the input in this case now. Which is better? You decide. After I do my technique, you decide the agenda. Okay, so maybe you know what I can do. I think before I take this particular question, because it might get a little more technical to you, I think maybe I can take a small question of my own and illustrate the concept. I think that will be better because I'm using a new technique altogether. So just give me a second. I'm just going to share a small little input from my side. I'm going to share you a question with the help of which I'll illustrate the calculation of my EPS. I'm going to show you a question, that's it, nothing more. Just give me a second. I just need to cut this question and show it. No worry, I'll just paste that out as well on the Excel sheet also. No worries on that. Just give me a second on that. So maybe I can do one thing. I can maybe do two questions with you on a bonus and a right issue, so you get a little more feel on that part. I think that's a brilliant idea. So let me do one thing. Let's give you two questions. One, I'll do a bonus issue, an example, and then a right issue as per my technique, and then we'll get the results. So I'm sharing a question from my side to you. Have a look on this. Okay, let's have a look on this particular question. It says an entity makes a bonus issue 1 share for every 5 shares held on 1st July. Quick questions to you, friends. Is this situation 1? Is this situation 2? Or is this situation 3? No favor, full favor, or you can say a case of a partial favor. And that's right, it is situation 2. So I'm going to put it like this, that this is a case of, you can say, 100% favor. It is a case of a 100% favor. If it is a case of 100% favor, am I considering the date of the bonus issue? No. So is the date of the bonus issue relevant? No, this is completely irrelevant for me. I will consider as if the bonus was made at the beginning of the earliest reporting period. So we are given the profits attributable to ordinary shareholders. You're also given the number of ordinary shares, and we need to calculate the EPS in the accounts of X8. So you're going to calculate three earning per share. One is you're going to calculate the basic EPS for the year X8. One is you're going to calculate the basic EPS for X7 as was originally reported. And one is you're going to calculate the basic EPS for the year X7, which is going to be restated as well. So what I'll do, I'll just paste this question across on the Excel, because once you get the Excel, you will also get this input as well. Okay, so I think let's begin the journey. What I'm going to do now in this particular case, calculate my basic earning per share. Now we're going to calculate the basic earning per share in this particular case for the year X8. So let me just organize the data. So I'm just organizing the presentation 2000 X8 and 2000 X7, in which you can show the original, calculations and the restated calculations as well. So that is how we are going to present it in the exams as well, giving the EPS for the year X8, that is current year, and also giving the EPS for the previous year originally reported and restated. So let's go with the numerator to begin with. So as far as the numerator is concerned, I think we can clearly see the inputs on the numerator just to show you. 5,50,000 and 4,60,000. So this works out at 550 and 460. So this is 5,50,000 and this is 4,60,000 and this is 4,60,000. And let's also take the denominator. So as far as denominator is concerned, I put the wrong spelling on the denominator. Let me put it like this. Okay, so on the denominator front, can I say the company is got in the year X7 10 lakh shares. The company issued one share for every 5 shares as a bonus. So 1/5 on 10 lakh becomes 2 lakh, and therefore the total number of shares is given 12 lakh. So in this particular case, we can take 12 lakhs. That is the number of shares. This is going to be, this is 12 lakhs. And this is supposed to be originally 10 lakh. And this is going to be 12 lakhs again. So this gives me the status. This gives you the status in terms of the number of shares. Now you can get the basic earning per share. So we can now easily get the basic earning per share. We have not given any weightage to the fact. And bonus is not considered 12 lakh. Bonus is 24 lakhs. Why do you get 24 lakhs? The number of shares was 10 lakh. And then there is 1/5 bonus issue that is 2 lakh, that makes it 12 lakh. I didn't get that. Bonus 12 lakhs by 5. Why do you say 12 lakhs by 5? Bonus is considered from the beginning of the earliest reporting period itself. So what we've done is correct. Just watch the calculations. Okay. So now let's see the basic earning per share. This is going to be the numerator divided by denominator. We get the numerator divided by denominator, and again we get the numerator divided by denominator. So that gives me the earning per share for the current year as well as originally reported for the previous year and the restated, because technically 0.46 is not comparable to 0.43. But 0.38 is comparable to 0.45 because that is both after the bonus issue. So bonus issue becomes very easy because in this particular case, you land up considering the beginning of the earliest reporting period itself. Okay, now let's go further. That was bonus issue. Now let's go further. From 10 lakhs to 12 lakh, which means 2 lakh is the bonus issue. Yes, that's absolutely correct indeed. Again, now let's take you to a question on a right issue, which is going to be interesting. So watch this carefully because I'm going to give you my technique. I'm going to give you my technique in terms of how I handle the case of a right issue. So let me share a question to you. I'll paste it across as well, not an issue. It says an entity issued one share for every two shares by way of a right issue at the rate of $1.5 on 1st July X5 and the pre-issue price was 3. The profits are given, the number of shares are given. And you can see that there were 8 lakh shares and the right issue is 1 for every 2. So 1 for every 2 means that there is a right issue of 4 lakh. 1 by 2 on 8 lakh, that makes it a total of 12. So by the way, just to put across, which situation is this? Is it a case of a complete favor or a case of a partial favor? Situation number 2 or 3. 2 was a bonus issue and this becomes a case of situation 3. Wonderful indeed. So this becomes a case you can say it is a partial favor. Now I'm going to click off things initially, absolutely simple. Well, I would say that when you're calculating the EPS in terms of right issue, you can apply a simple 3 steps. And the first step, even what the standard says, is calculating a theoretical X right fair value per share. And let me, I think, also quickly revise the logic with you based on that. When you're calculating the theoretical X right fair value per share, it is based on what is going to be the price of the share, which is post the right issue. Let me quickly put another question to you. The market price of the share before the right issue is 3 and the right issue price is 1.5. I'm making a statement. Please watch this carefully. Is it right or wrong? Can I say I did a favor to the shareholder to the extent of 1.5? 3 minus 1.5 is the difference 1.5 the favor given to the shareholder? Yes or no? The price of the share was 3 rupees and it became 1.5. Is that the favor to the shareholder? And I get the answer yes. No, my friends, no. That is a biggest misconception. The favor is not supposed to be the difference between 3 and 1.5. Reason: 3 is the price prior to the right issue, and once the right issue occurs, this market price will fall down. So the actual favor is not a comparison of 3 and 1.5, but it is a comparison of the market price post the right issue versus 1.5. I hope I'm making sense. And in fact, when you calculate the theoretical X right fair value per share, the theoretical X right fair value per share will be compared with 1.5, and that will be the bonus element. Let's see. So what are we going to do? First of all, let me just paste this across and let's go back to the Excel. Let me now work this out. So I'm wanting to calculate a basic earning per share in this particular case. So first of all, what I'm going to do, I'm going to follow my 3 steps, which I said in step number 1. In step number 1, we are going to compute. We're going to compute what is called theoretical. It is called theoretical X right fair value per share. And this theoretical X right fair value per share is nothing, but it represents that what is the price of the issue post the right issue. And trust me, there is no way you can calculate this particular price. And that is the reason what we do. we just take a weighted average of the prices. We will consider that what was the number of shares prior to the right issue. The company had 8 lakh shares and the price of the share was 3 rupees per share. And when they issued another 4 lakh shares, they issued them at 1.5. So what we're going to do, we're just going to take the product. The company had a total of 8 lakh shares. So you multiply the 8 lakh shares at the rate of 3. Then the company issued 4 lakh shares and this was issued at 1.5. And the total number of shares the company gets is a total of 12 lakhs. So we are indirectly considering what? We are considering a weighted average, if you notice. If you technically notice, we are nothing, we're doing just a weighted average in this particular case. We're saying the company had 8 lakh shares at the price of 3. They issued another 4 lakh shares at the rate of 1.5. Let's see what is the weighted average. That becomes a theoretical X, right? So that makes it 24 plus 6 divided by 12. I think that works out at 2.5. Now let me make another statement to you and get the vouching done. Can I say the bonus element is the comparison of this 2.5 versus 1.5? Is that correct? If you now ask me what is the bonus element, I'll say it is 1 rupee and I get the answer no. I am absolutely correct. You know, when the bonus issue is made, sorry, the right issue is made, you need to understand that the shareholder will be able to get a benefit. The shareholder will be able to get a benefit. He can sell the share at the rate of 2.5. So you gave him the share at 1.5 and the share price post the right issue is 2.5. So the favor is 1 rupee. That is 2.5 minus 1.5. 3 cannot be compared with 1.5. I hope I stand clear on that. The very concept of theoretical X right fair value per share is calculating the price of the share post the right issue. And that can be compared with the issue price to get the bonus element. Now I'm going to do my new calculations on the step number 2. Now watch this, what I am going to do in terms of the step number 2. Now in terms of the step number 2, what I'm going to do, I will identify the bonus element. Now watch this calculation. If this clicks, it clicks in a second. If it clicks in a second. So what is the total right issue? The total right issue is to the extent of 4 lakh shares. Now what I'm going to do, I'm going to calculate the proceeds. The company issued 4 lakh shares. The company issued 4 lakh shares at the rate of 1.5 per share. So what was the total proceed? It was 6 lakhs. Now let me ask you something. Let me ask you something. The shareholder gave me 6 lakhs. If I would not have done a favor, please mind the question. If I would not have done a favor, I would have given the shares at what price? Tell me. If I would have done no favor to the shareholder, you would have given the shares at what price? Can I say 2.5? Because the price which is going to prevail post the right issue is not 3, is 2.5. You are giving him a share which is going to be worth 2.5 post the right issue. So indirectly, if you would have done no favor, you would have told the shareholder that I am going to give you shares at the rate of 2.5. Now please do a little backward working. Divide the 6 lakhs by 2.5. You would have given how many shares? You would have given 2.4 lakh shares at the rate of 2.5. I hope you got the picture very clear. And trust me, this is exactly the kind of calculations which you do when you consider the case of options in diluted potential shares. I have used exactly the same technique. And in this particular case, we can say we have identified the bonus element now. The bonus element in this particular case is the difference between, you can say, the 4 lakh shares minus the 2.4 lakh shares, and that is supposed to be 1.6 lakh shares. I'm going to make my statement now and you can vouch me. Can I say I will consider 1.6 lakhs from the beginning of the previous reporting period? And I'll consider 2.4 lakhs from the date when the bonus issue, from the date when the right issue is made. Is my understanding correct? When you go to consider the calculations of the basic EPS, I will consider 1.6 lakh from the beginning of the reporting period. And the remaining 2.4 is what I'm going to consider from the date of the right issue. Did you get my technique? Is it good or not? That you just need to identify the price post right issue called a theoretical X right fair value per share and get the bonus element in the step number 2. No need to calculate any adjustment factor. I know you must be now thinking, sir, can I apply this technique in the exams as well? Why not? The technique is absolutely logical and scientific. So you can use the adjustment factor, you can use this technique, whatever you feel is more good, whatever you feel is more comfortable to you. Okay, so let's now come to the step number 3, which is now making the calculations of the basic earning per share. Because with this, you are able to identify easily things in the chart. So I need to make a chart again because we need to consider the timing factor. So let's consider the particulars. Let's consider the number of shares. Let's consider the number of months it has been outstanding. And let's consider the product as well. So we keep considering the same inputs itself. Now let's create the blocks. If you want to create the blocks now at this stage, my financial year is January to December. So we made a right issue in the middle of the year. So the block is January to June. So we can say the first block is going to be 1st of January. And this is till 30th of June. And we can also consider the next block, that is 1st of July. And this is going to be till 31st of December. This is going to be 31st of December. Now let's take the number of shares. In this case, we had 8 lakh shares. This is for the current year I'm doing. So this is 8 lakh. And to this, you're going to add what? Only the bonus element. Only the bonus element. And what you're going to do out here, can I say you're going to add both the elements? The bonus element got added for the entire year and the fresh issue get added from this block. So this is outstanding, I guess, for 6 months. This is outstanding for 6 months. Let's take the product. I think 9 lakh 60 into 6. That works out at 57 lakh 60,000. And it is 12 lakh into 6. I think that works out at 72 lakhs. So we can get the product in this case. We'll organize the EPS for the other years as well. And we take the product that is 12. Okay, so now I think with this particular inputs, we can get the weighted average number of shares as well. So WANES, and this is going to be 1,29,600. 1,29,060, sorry. 129,60,000 divided by 12. So this works out, I guess, at 10.8 lakhs, I guess, is the weighted average. Good. Now with this inputs, now we are in a comfortable position to calculate the basic EPS exactly the way we organized it previously. So we need to organize the basic EPS for the current year. And we need to organize the basic EPS for the last year. And this also originally computed and restated as well. That's how we organize the data. So we'll get the basic earning per share because this weighted average which we got is for the current year. So let's take the basic earning numerator and let's take the denominator. So I guess let's come back. The numerator is 5 lakh 50 and 460. So numerator for the current year is 5 lakh 50. Numerator for the last year is 4 lakh 60. Even for the restated, it is 4 lakh 60. And we consider the denominator. Can I say in this particular case? In this particular case, the denominator for the current year, we've calculated, I guess, 10 lakh 80. And for the last year, I think it was 8 lakh. Can you tell me what will be the denominator for the restated EPS? You need to consider the bonus from the very beginning of the previous year. So can I say to the 8 lakhs, we're going to add 1 lakh 60. That works out at 960. So we can get the basic earning per share. So numerator divided by denominator. And we get the results in this case. Wonderful indeed. So calculation becomes a little clerical indeed. But I think otherwise it's pretty fine and straight. Good. So I think I wanted to share my technique of a right issue. I hope you got the technique with a three-step model. First, get the theoretical X right fair value, which is nothing but a weighted average of the shares prior to the right issue and the proceeds. Get the bonus element, split the right issue in terms of two parts. The bonus is taken from the beginning of the earliest reporting period, and the right issue is taken from, you can say, the date of the issue. Okay, so far so good. So this is done. Now let me go further. I hope you love the technique. You want me to do this now, the question which we were doing with this technique itself, the question which I have organized, you want me to do it with my technique now? Let's try this then. I'll share the question back again. Now we're going to come to the question number 5 and have a look. Let's have a look at this question. Now, interestingly, in this particular question, we are given the calculations of the EPS for a period of 3 years. That makes it interesting because we need to be careful in terms of the last year restatement, current year, the split. And then he has asked you the next year as well, just to be on the very safe side. It says calculate the EPS. We're given the data for X1, X2, sorry, X0, X1, X2. The profits attributable to the ordinary shares are given. Then we're given the shares before the right issue. The right issue is 1 share for every 5 shares. There is an exercise price 5. There is a date of right issue, which is January X1. It is going to be exercised on 1st March. And the market price of the share before the right issue is 11. And the reporting date is December. Quick questions back to you. Is the bonus element 11 minus 5? Is the bonus element supposed to be 11 minus 5? What do you say? I am keenly waiting for this, and I like the answer, of course, no. Now we get the big capital no. Because earlier, when we were asked you the question, you said yes. Now you're going to be very careful in that part. So we need to get the right issue, the theoretical X right value, and get the results. So let's proceed. So let's do the question number 5. So in this particular case, let me organize the data. Step number 1, we need to get the theoretical X right fair value per share. So let's get the theoretical X right fair value per share in this case. So let's, I think, again, look at the data. I guess the company had a total of 500 shares and the right issue is 1 by 5. That makes it 100 shares. So 500 into 11. That makes it 500 into 11. The right issue is 100 into what is the price at which it is made. The excise price is 5. And divide this entire by 600 shares. So this is, I think, 500 into 11 plus 500 divided by 600. I think it works out at 10. Then we go to the step number 2, and we need to get the bonus element. Instead of getting the adjustment factor, let's get the bonus element. So first of all, I need to get the proceeds. What is the proceeds? We're issuing 100 shares at the rate of 5. That makes it 500. The proceeds would remain 500. Now tell me, what will I do? I'll divide 500 by what? I'll divide 500 by what in order to get the number of shares? And that's right, divided by 10. So can I say this is going to be 50 into 10? So let's see what is the bonus element in this case. Can I say the bonus element is going to be 100 shares minus 50 shares? That works out a total of 50 shares. That is the bonus element. That makes the life so simple. Because adjustment factor becomes a very mechanical exercise. And once you get this, you're pretty confident in terms of your calculations as well, that what you have done is absolutely correct. Now let's go to the step number 3. Now we need to calculate a basic EPS, but this time we're required to calculate a basic EPS for 3 years. Okay, so now let's move forward with this. So an exam such presentation is okay, or some formula is putting for marks? No, I think this is pretty okay. Because I think in terms of step 1, you can definitely put the formula where you can say number of shares prior to the right issue into the market price prior to the right issue plus the proceeds of the right issue divided by the total number of shares. Then in step number 2, you can simply show the calculations of proceeds and identify and do the split and show what is the bonus element. You can perfectly do that. Step 1, yes, you can define the theoretical extra price with the formula. Okay, now in this particular case, what I need to do, I need to organize my EPS. Now also let me show you something. The right issue is made in X1. Quick questions to you at this stage. Can I say the bonus element will be taken for the entire X0? The bonus element will be taken for the entire X1, X2, correct? The bonus element will be taken for the entire year X0, and you can say even for X1, X2. That's right. And the right issue element is going to be taken, can I say, in X1 from the date of the right issue 1st March, and for X2 12 months. Correct? The right issue element, the fresh issue element will be taken accordingly. That's right. So let's, I think, do the calculations. So we've got the EPS for the year 2000 X1. Rather, let me take first of all 2000 X1 only. Then, or let's go with the same order. 2000 X0. This is last year. Then this is 2000 X1. This is like current year. And 2000 X2, which is like next year. That is post the right issue. And we'll show original computation. We'll show the restated calculations. Okay, so now let's organize the numerators and the denominator and get the results. So let's see numerator. Let's see denominator. So I think first let's look at the numerator. So in the previous year, it was 1100. And the number of shares, this was 1100. And this is to the extent of 500. And now we need the restated. It is 1100. And restated is going to be 550. Let's take the current year as well. Current year is 1500. And in this particular case, we need to get the weighted average. I'll do that. And then for the next year, I guess the profits are 1800. And this will, of course, be 600. So let me just organize the weighted average shares. Weighted average number of equity shares is what I need. So let's make the column particulars. The number of shares. We take the number of shares. We take the number of months. And we take the product as well. So let's consider. We're going to consider now the block of dates. So what will be the block of dates in this case? Can I say the right issue is made on 1st March? Can I say 1st January to which date? The first block is going to be 1st January till which date? 28th February, I guess, because we're working on the 1st of March, 28th February. So that is 500 plus 50. And then we consider 1st of March to 31st of December. And that's going to be 600 itself. This is, I guess, 2 months. And this is, I guess, 10 months. So let's get the product. 550 into 2. That's 1100. And that's, I think, 6,000. So this works out at 7,100. And this is 12. Let's get the weighted average number of shares, WAS. That is 7,100 divided by 12. So I think this works out at 591.67. So we can put this out here. This is 591.67. Calculations all the way. Okay, so let's get the basic earning per share as well. But at least, this takes care of the inputs on the basic EPS, right issue, bonus issue, everything is done. So this is numerator divided by denominator. Miss this part. Numerator divided by denominator. Well, so I think this is done. So the calculations of the basic EPS is done. Now some more crucial points on the calculation of basic EPS. So I think this takes care of, just connect the dots. This takes care of the inputs in terms of basic EPS. In fact, what I have done, if you'd have actually realized, I did not take the bonus issue and the right issue as a special issue in terms of basic EPS. I incorporated that in the denominator. So when you're just going to create a mind map at the back of the mind, you can always consider that denominator involves a total of 3 different kinds of situations. You need to see that if there is no favor, you give a due weightage to the timing factor. Number 2, when you consider that there is a complete favor, just like a bonus issue, you need to consider from the beginning of the earliest reporting period. And when there is a partial favor, you need to split the portion. The bonus is taken from the beginning of the previous earliest reporting period and the right issue treated like a fresh element. Right, friends, so far so good. Now let's go further. So we did the question number 5. I now need to take you to the question number 4. Wow. Special issue related to this calculations now. Break a little later, I guess. That's a little early, I think. Maybe another 10 minutes or so, I guess. Let me just do the quick question because they want to take up the diluted EPS, after that. So I think I'm just going to quickly take you on another interesting question. Okay, now let's have a look at this. This is a very interesting question because this is pertaining to, you can say, a case where you've got two classes of shares. I don't know if you've done this two classes of shares or not, but it's, I think, a very interesting issue. Let me read. It says an entity has got two classes of share. One is a non-convertible preference share and one is 10,000 ordinary share. It's basically participating preference shares in this particular case. Let's read. It says the preference shares are entitled to a fixed dividends which is 5 rupees per share before any dividends are paid to the ordinary share. The ordinary dividends are then paid in which preference shareholders do not participate. Then he says each preference share then participates in sorry, additionally ordinary dividend of 2 at the rate of 50% of any additional dividend payable on the ordinary share. So it says that there is additional dividend, additionally ordinary dividend above 2 rupees at the rate of 50% of any additional dividend payable on the ordinary share. The profits of the company is 1 lakh and the dividends are 2 rupees per share and they are declared on the ordinary share. Compute the allocation of earnings for the purpose of calculating the basic EPS when an entity has got an ordinary and participating equity instruments that are not convertible into ordinary shares. Now, would you like to tell me how would I proceed with this particular question? When you've got two classes of shares, in this case, the ordinary shares and the non-convertible preference shares, what am I supposed to do? Give me a technical term which I am supposed to do. So let's wait for your inputs. What do you say? What are you going to do in this particular case? I want to hear that interesting term. Then what do we do in this particular calculations? Okay, no input so far. You've done this question earlier, right? Okay, I got the answer. Earning is reduced from the ordinary shareholder. So can I put the focus? Maybe you can vouch me. I need to get the distributed and the undistributed earning. Can I say the EPS will be a sum total of the distributed and the undistributed earnings? Is my thought correct? We need to basically get the distributed and the undistributed earnings. Wonderful. So let's, I think, first of all, start working on the distributed earnings. First of all, we're going to work upon the distributed earnings in this case. So let's go back to the question. So I am given in this particular case, it says the profits of the company is 1 lakh. So let's take the profits. The profits of the company is supposed to be 1 lakh. And from this, you're going to reduce, first of all, the preference dividend. So let's reduce the preference dividend in this case. I guess if I just work out the preference dividend, we given the preference shareholders are given a fixed dividend of 5 rupees a share. So we given them 5,000 shares at the rate of 5. And that works out, I guess, at 25,000. And then we can get the status of the ordinary dividend as well. So less the ordinary dividend. Non-convertible is not a potential share, but first distribute the earnings to non-preference shares. That's right. So now we give the ordinary shares dividend. So ordinary dividend. And I guess if I look at the ordinary dividend, they are given dividend at the rate of 2 rupees per share. So that works out at a total of 10,000 shares into 2. That works out at 20,000. And this is going to give me the undistributed earnings in this case. So this is also the undistributed earnings. So we can say basically we have got in the very first step the distributed and the undistributed earnings. So let me make it like this: distributed and undistributed earnings. So we need to first of all get the distributed and the undistributed earnings in this case. Okay. Now what we need to do, we need to organize the data. Let's see the ordinary shares and let's see the preference shares. So we've got the ordinary as well as the preference shares as well. And let's organize the basic EPS. Let's first organize distributed, the distributed portions, the undistributed portions. So I think the distributed portions is 2. The distributed portion is 5 per share. Now, tell me, how would I divide this 55,000? He tells me that each preference share is going to get, it says each preference share is going to get additional dividend above 2 rupees at the rate of 50% of any additional dividend. So can I say if the ordinary share get 1 rupee, then the preference share gets 0.5? So can I say the undistributed earnings will be distributed 2:1 per share? Is the thought correct? Because if you're going to give 1 rupee to the ordinary shares, you're going to give them 50 paisa to the preference share. So can I say 1:0.5, or we can say 2:1? Is that the distribution on a per share basis? Is my thought correct? Do you vouch me for that? That in this particular case, we distribute 2:1 and then consider the number of shares as well? Yes. So let's, I think, come back on the agenda. So you can give 2 into what is the number of shares we've got for the ordinary? 5,000 shares. And in this particular case, you're going to give them 1, and number of shares in this case is 10,000. So this will be divided, I guess, 1:1. So this is 2 and this is coming to 10,000 is to 10,000. So, okay, I think I just taken, that's 5,000, sorry, I think I've taken that wrong. This is 5,000. So let's divide this in the ratio 2:1. So maybe we can do it like this. I think it's better. Let me put it like this, that you are going to give dividend of 1 rupee, or let's say you're going to give them dividend of X rupees multiplied by X into 1 rupee into, there are how many ordinary shares? 10,000. Plus you're going to give them X by 2 into, so you give them X by 2, dividend is X by 2. Okay, just a second. So X rupees into 10,000, and this is X by 2 into 5,000. This is equal to 55,000. I think that's better to solve the equation. So let's get the solution of this equation. We're paying X rupees per share to the ordinary shareholder. So we're going to pay X by 2 to the preference shareholder into the number of shares equated to 55. So I think this comes to, what is the value of X, I think, coming to? Is it coming to 4.4, I think? So ordinary shares will get 4.4 and preference will get 2.2. So this works out at 6.4 and this works out at 7.2. So this is the basic earning per share for the 2 categories of share. Wow. So that was just a little mathematical calculations indeed. I know you're wanting a break, but I just want to finish one small little question. Then I'll definitely give you a break because my basic EPS will get over. Then we'll start with the diluted earning per share post that. Okay, so this is done, 4 is done, 5 is already done. Okay, now comes the question number 6, which I want to take up. That's an interesting one. Now, let me ask you a simple question before we solve this. My question is, when you've got compulsory convertible debenture, is it considered as a part of the basic EPS? Do you consider the compulsory convertible debenture as a part of the denominator in a basic EPS? Or is it considered just like a normal debenture? What do you say? Because this is one very interesting question. I don't know if you have done this earlier or not, but it is on a CCD, compulsory convertible debenture. So do you consider the impact of compulsory convertible debenture in terms of the basic EPS calculation? Yes or no? I think I am very keenly interested to know this. Or maybe you're doing it for the first time. The impact of CCD on the basic EPS calculations. Okay, that's right. It is considered as a part of the basic EPS. So let's read and then we'll solve this particular question in this case. That's correct. So we are given the ordinary shares, and that is the ordinary shares are going to be 1st April 19. So we given the ordinary shares, and then there is a fresh issue as well. And then there is a buyback as well. And then there is a CCD. So I think it's all about getting a weighted average. The PAT is given. We given that this is to be converted to 100 lakh equity shares on December 31st, 23. That's it. So I think let's work on the numerator and denominator. Question number 6. So we go to the question number 6. Let's, I think, first work on the weighted average number of shares, particulars, number of shares, number of months, and we consider the product. So now we need to make blocks and get the weighted average. So let's start making the blocks in this case. So let's create the first block. My financial year is supposed to be, I guess, April to March. So I am given 1st April. So what is the next break? 1st October. So can I say 1st April to 30th September? So we're going to take the first one, 1st April to 30th September. And I guess the number of shares is supposed to be, it says 100 lakhs. So that is the value. The face value is 10. So we'll take 10 lakh shares. So this works out at 10 lakh shares. And this is going to be outstanding for how many months? April 30th September, I guess 6 months. Now let's create the second block. Let's, I think, ask you the question. Where will I take the second block? Which date to which date? 1st October, and I think the next change is coming in, I guess, on the next change is supposed to be coming in, I guess, on the fresh issue. Okay, I think this is number. I think I've taken this, should be taken as number. Let's take this as 100 lakhs only. It's number. Okay, so next block is going to be what? Can I say starting from which date to which date? The next block is going to be 1st October till 1st December is the buyback. So 1st October till which date? 30th November. So 1st October, I think now everybody is tired. I did not give you a break, so nobody wants to give me an answer. Don't worry, you're going to get a break after this question. Just that I wanted to finish one particular concept on this. Not like that. Okay, that's perfectly fine. Okay, so in this case, we have got fresh issue is 10 lakhs, so this becomes 110. And this is going to be, I guess, 2 months. Then we go to the next block. The next block in this case is there is a buyback, and on 1st January there is a CCD. So there is a CCD. We're actively hearing your region words carefully. That's great. Super. I love you for that. Okay, so now there has been a buyback, so we reduce the number of share. This comes to 90 lakhs, and this is going to be 1st of December, and I think this is going to be till, so this is going to be till 1st of January, so end of December. That is 31st of December. So this is going to be a period of 1 month. And then we get 1st January to 31st March. I think that is the last block. And that's right. So this is going to be the last block is CCD. It's another 10 lakh. So another 10 lakhs in this case would make it a total of, no, it's 10 lakh or more than that. We're going to issue 100 lakh equity shares. So 100 lakh would mean 190 lakhs, and this is 3 months. So let's take the product. This is 600 lakhs. This is 220 lakhs. This is 90 lakhs. And this is, I guess, 190 into 3, 570 lakhs. That's absolutely correct. Wonderful indeed. So now with this, we can do the calculations. So this total works out at 600, 220, 90, and 570. 600 plus 220 plus 90 plus 570. That's, I think, 1480. That's correct. So this works out at 1480 lakhs. And this is going to be 12 months, of course. So let's get the weighted average in this case. So we get Wayne's weighted average number of equity shares, 1480 lakhs divided by 12. Let's get the weighted average. And I think that's 123.33. That is the weighted average. Okay, now this takes care of the numerator. Now we need to focus on the denominator as well. Sorry, the numerator as well. So tell me, what will you take in terms of the numerator? Are you going to consider the impact of the interest? Because the profits which is given would be after considering the interest on the CCD. So while calculating the basic EPS, are you going to add back the interest? What do you say? So are we going to add back the interest in this particular case, considering the PAT is post the interest? So we're going to add back the interest net of tax, right? Absolutely correct. So I think in this case now, we just get the numerator as well. So let me get the numerator calculations. So we can say the PAT is 760 lakhs, and we just can add the interest net of tax. So we take the interest net of tax. So let's get the calculations of the interest. So we given there are 10 lakh CCD, 100 each, 10%. So 10 lakhs, and that is 100 each. Interest is 10%. Taxes, I guess, at the rate of 30%. So we take it net of tax. That is 70%. So let's see what is the result. This is 10 into 100 into 10% into 70. I think that works out at 70 lakhs. So this works out at 830 lakhs. So we are now in a comfortable position to calculate a basic earning per share, that is 830 lakhs divided by 123.33 lakhs. And we get the basic earning per share. Right, so that works out, I guess, to the extent of 6.73, I guess. That's right, absolutely. So that works out at 6.73 is the basic earning per share. Wow. So I think that takes care of the inputs with reference to the calculations of the basic EPS with special issues like right issue, bonus issues, CCDs, etc. I think now it's definitely time to give you a break because we're going to talk in terms of diluted earning per share post the break. Enjoy your break. I'm sure you need it badly. Okay, so I think we'll take a break, friends, 10, 12 minutes, and then I join you back. Right. Welcome back, friends. I hope you had a relaxation of mind. So, we've so far made our discussions on the concept of basic earning per share. Now, we are going to discuss the concept first of all, and then do questions on the concept of diluted earning per share. So, I think, first revise the concept in terms of diluted earning per share. Now, just like we made some quick notes in terms of basic EPS, let's also remind ourselves in terms of the concept of diluted earning per share. Now, I always tell people that when you look at the concept of a diluted EPS, what comes at the back of my mind is a little step-by-step procedure of calculating a diluted earning per share. Now, at the first instance, of course, what do you need to do? That you need to see that is there one or is there more than one category of potential ordinary share. The way you tackle a question where there is just, let's say, one potential ordinary share, vis-a-vis the way you tackle if there is more than one potential ordinary share is different. So I think for the time being, let's consider that if there is, let's say, one potential ordinary share, how do we tackle the agenda? So in this particular case, I would say it's a simple three steps which you can apply. In terms of step number one, you need to first appreciate that the concept of diluted EPS applies only when there are potential ordinary share. So we need to identify whether potential ordinary shares are present or not. So we need to decide, is the potential ordinary share present or not? Now, there are a couple of examples of potential ordinary shares. I think the most common stands in terms of convertibles, convertible debentures, convertible preference shares, and you can say in terms of ESOPs, that is options. So you need to basically identify that, okay, is there potential ordinary shares or not? If you say yes, then it's time to go to the step number two. But if we say no, the potential ordinary shares are not there, then the concept of diluted EPS is not applicable. Then in that case, there is no concept of a diluted earning per share. So the first thing what you need to zero down on the question is identify that is there a potential ordinary shares or not. Now, once you identify, yes, there is a potential ordinary share, you go to the step number two. And in step number two, you need to basically, you can say, identify. You need to basically identify that these potential ordinary shares are dilutive or anti-dilutive in nature. So you need to identify that they are dilutive. They are dilutive or anti-dilutive in nature. Because this will decide the fate whether we are calculating a diluted EPS or not. So the second step is going to focus on identifying whether these potential ordinary shares are dilutive. Dilutive, is got the impact of decreasing the basic earning per share. And anti-dilutive would mean that they've got the impact of increasing the earning per share. So if they are supposed to be dilutive in nature, then you can go to the step number three in order to calculate the dilutive EPS. But if they are supposed to be anti-dilutive in nature, then in that particular case, the concept of diluted EPS is not again going to apply. Now, the only caution which you need to apply in this particular case is, which I'll put as a note, that when you make an assessment whether a potential ordinary share is dilutive or not, you need to consider the control factor, the control figure as the profit from continuing operations. So we need to consider the numerator, the control figure to identify, we need to consider the profit or loss, what do you call it, from CO, that is continuing operation. We're not going to consider the total profit or loss in terms of identifying whether a given potential ordinary share is dilutive or anti-dilutive in nature. We just need to consider that the profit or loss from a continuing operations is going up or is it going down. And then finally, you come to the step number 3, which is the calculation of the diluted earning per share. And of course, when you consider the diluted earning per share, we will consider the profits and loss from CO as well as DO, the continuing operations as well as the discontinued operation. Now, this is typically when you're looking at one potential ordinary share present. Then in the first instance, you say, okay, there are potential ordinary share. We say yes. Then you go to the step number 2 to identify their dilutive, anti-dilutive in nature. You say yes, they are dilutive in nature. And then it is calculating diluted EPS. So you can see the step number 2 and 3 differs with respect to that step 2 is focusing on identifying whether it is dilutive or not. And the figure is based on CO. The third is the computation, and which is based on the total operations. That's the main distinction. Now, if you get more than one potential ordinary share, in that particular case, in terms of step 2, so if you've got, let's say, more than one potential ordinary share, well, in that particular case, the only changes what you got to do in terms of step 2 is create a statement of ranking. Because in this particular case, we need to rank and see which potential ordinary share has got the most dilutive effect. So that would be an additional exercise that you will have to make a statement of ranking and then identify within the ranking two things. Is it dilutive or not? That's one. And secondly, you also need to identify that in which order you will consider the dilution. And then step 3 is again making the calculation of diluted EPS. Now, just like a basic earning per share, what we need to consider is the numerator impact and the denominator impact. Because an EPS is all about looking at the numerator and looking at the denominator impact. So when you look at the numerator impact, what do you need to do? You need to take the basic EPS numerator as a base. And to this, you need to add the interest. You need to add the interest that is net of tax. Is there any convertible debentures, for example? Is there any convertible debentures, for example? So in this particular case, what you need to do, you need to add the interest net of tax. Similarly, when you consider this base, you also need to reduce, let's say you need to, add back any preference dividend. Because if you're looking at the preference shares, then the preference dividend which was being paid earlier is no longer going to be paid. But remember, if you've got more than one potential ordinary shares, you cannot make the adjustment to the numerator in a single go. Though I've written on the numerator, you take the basic EPS as a base and you add the interest of tax, you add the preference dividend, but that does not mean that it's going to be a change in collective. Because when there are more than one potential ordinary share, you need to make the change. You need to adjust the numerator based on the ranking. Similarly, in terms of the denominator, you would take the basic EPS numerator as a base. You will take the basic EPS denominator as a base. And to this, you will add the increase in number of shares due to conversion. Number of shares due to conversion. Now, here, there is a very important input you need to be careful on. Generally, when you're considering the change in the denominator, you always consider as if the change is made at the beginning of the year, as if the conversion took place at the beginning of the year. But then there could be certain potential ordinary shares which were issued during the year itself. So if they were issued during the year, then we need to be careful because they can be inserted in the denominator only from the date they were actually issued. So you need to consider that when you consider a weighted average number of shares, you need to consider them from the beginning if they were issued in a prior year than the previous year, or you need to consider them in between the year if they were issued at a later date. So this is one thing you need to be very careful that potential ordinary share have been outstanding from the previous year itself, or these potential ordinary shares are something which are issued in the current year. then accordingly, you need to consider them in the denominator for that concerned marks. That was a quick view in terms of the diluted earning per share. Now I think let's do question. So we'll do first of all two questions. One based on a single potential ordinary share, and then I guess we'll take to more than one potential ordinary share. So let me first share a question to you, which is based on, let's say, a single case itself. Simple one. It's one of the questions which came in the RTPs, and this was single potential ordinary shares an option. Let's look at a question number 10. There is another thing which also comes to my mind, that we can also make a summary mind map in terms of different potential ordinary shares and see what is the impact on the numerator and what is the impact on the denominator. But I think we can do this exercise maybe after this particular question. So I think let's have a look at question 10. The profits attributable to ordinary equity shareholders is given. The weighted average shares are given. The average market price of one share is 20, and the weighted average number of shares under the option is given. The company is issued option, and that becomes a potential ordinary share. The exercise price is supposed to be 15. We need a basic and a diluted EPS. Now, quick question. Is there one potential ordinary share or more than one? I think undoubtedly one. And is the option potential supposed to be dilutive, supposed to be potential ordinary share? Undoubtedly, yes. Now, let me make a strong statement. Let me make a very strong statement. Can I say, in terms of option, it is always dilutive in nature? I don't see a possibility that options would ever be anti-dilutive in nature. Do you agree with this statement? What do you say? And that's rightly agreed. Absolutely makes sense. So in this particular case, absolutely makes complete sense. Just a second. I just need to close a particular file. So that's rightly given. It is undoubtedly. So, but still, in this particular case, I think once we're doing the calculations, I think maybe we can do the check. But let me now put another interesting question to you. I'm just thinking aloud that though I gave you a three-step model, but I'm just thinking, can I say if there is no distinction between CO and DO, is the identification that potential ordinary shares are diluted and the computation of diluted EPS, is that going to be the same? Because if you've got no segregation in terms of CO and DO, your step 2 is based on total, your step number 3 is based on total. So can I conveniently also say that the calculation of identifying potential shares and indirectly you can say the computation is effectively the same? Agreed with the statement? Because if no segregations are given, I think it works that way. Absolutely. So let's go to the question number 10 now and let's solve this out. So we are on question number 10, which is a case of, I think I'd like to make a mention as well, help you in revision. This is one potential ordinary share. I'm putting as POS, potential ordinary shares. So I think first of all, we can say step number 1, or we can directly say options are potential ordinary shares. Now, let me now also consider what will be the change in the numerator and denominator. Does option leads to any change in numerator? And that's rightly said, not at all. So change in numerator is going to be 0. And let's see the change in denominator. Can I say in terms of denominator? Trust me, the calculations which I did for a basic earning per share in terms of right issue, 100% you apply the same technique. You get the proceeds. You get the proceeds, and let's see what is the proceeds. I am given that the company is issued 1 lakh options with the exercise price 15. So we can say 1 lakh options into exercise price 15, the proceed is 15 lakhs. This will undoubtedly remain 15 lakhs. Now tell me, if I would not have done any favor, then in that case, can I say I would have given the options at a market price 20? So in this particular case, we can say if we divide this by 20, I think it comes to 75,000 into 20. So trust me, exactly same calculations what we did in terms of right issue. So let's see what is the bonus element. Let's see what is the bonus element in this case. Can I say this is going to be 1 lakh minus 75,000, and that works out, I guess, at 25,000. So this is the bonus element, and trust me, when you go to consider the basic earning per share in this particular case, it is the bonus element which will impact. It is a bonus element which will impact the diluted earning per share. So let's go back to the calculations of a diluted EPS. We need to show both. Let's take the basic EPS. So my basic earning per share is 12 lakhs of profits and 5 lakh of shares. So we take 12 lakhs by 5 lakhs. It is a wonderful technique for calculation. Yes, I agree 100%. So we've got the numerator is 12 lakh and the denominator is 5 lakhs. So I think that comes to 2.4, I guess. Then let's consider the diluted EPS. So diluted earning per share, numerator no change, and denominator would be 5 lakhs plus what? Only the bonus element, that's 25,000. So I think this works out at 2.29. That's right, it comes to 2.29. So by the way, the quick question which comes to the mind is, in this particular case, can I see the EPS has fallen down? It proves it is diluted, and this is diluted EPS as well. It is absolutely diluted because EPS has fallen down. EPS has gone down, and that proves the fact that it is undoubtedly dilutive in nature, and that is the diluted EPS as well. So in terms of option, there is no change in numerator. So let me, I think, make a little quick mind map, a summary chart as well. You know, what is just coming in the back of the mind is just a quick summary chart on the impact of numerator, denominator of the earning per share. So let's take numerator. Let's take denominator. I guess generally we get 3 kinds of potential shares: options, preference shares, and we can say convertible debenture. So the question which is coming to the mind is, in terms of options, is there any change in the numerator? No. In terms of denominator, do we consider entire options or the bonus element in options? We consider the bonus element in options. That's right. So I think that's a quick chart, just getting the inputs, the change in the numerator. In terms of preferences, what do you add in terms of the numerator? The preference dividend without a tax impact. And what do you do in the denominator? Can we say take the entire increase? We take the entire increase into account. And in terms of convertible debentures, can I say we'll take the interest net of tax? So we'll take the interest net of tax, and again, sorry, we take the entire increase in this case again. Right, so I think that was a quick summary giving you an input in terms of how the impact on the numerator and the denominator is going to take place, because diluted EPS involves calculating the change in the numerator and the change in the denominator, and that's makes the quick summary. Okay, so that was one quick question on the concept of a single potential ordinary share. I think we'll do now a question which also came in the exam, though it's quite a level of a C intermediate question, where there was more than one potential ordinary shares in the question. Let's go back. Yes, this was the question number 12. There's an examination question. It came for 8 marks in the exam. I think other than this, I think generally the questions have been around 4 to 5 marks in the exam. But this question came for 8 marks in November 2020. But trust me, anybody who's got some, good, decent knowledge, even at the intermediate level, would have actually handled this question. Okay, let's have a look at question number 12. It says the following information is available relating to S Limited for the year 1920. You're given the net profits in this case. So I am given the net profits and the number of shares and the average fair value. And then you can see the potential ordinary shares, options, preference shares, convertible debentures. So we've got 3 inputs. We've got options, we've got convertible preference shares, and we've got convertible debenture. So which means we've got 3 potential ordinary shares. So I think what we need to do, first of all, I think organize what? Let me ask you that. What do I need to organize first? Though I think I've already given the inputs earlier. So we need to organize, first of all, that's right, options, but I think we need the rankings. We need to basically create a statement of ranking based on all these potential ordinary shares and then calculate a diluted earning per share. So let's begin with the data. So question number 12. So I think first we would organize the statement of ranking. And this is also going to be a set formatting which you can follow in the exams. Let's take particulars. Let's take the change in numerator. Let's take the change in denominator. And we need incremental earning per share. And on that basis, we'll give, first of all, remarks. And then we are going to give ranking as well. So in this particular case, I've just added the columns out here. So let me just highlight them. So we can consider options. So we can consider options. Then next, we give convertible preference shares. Convertible preference shares. And then we've got convertible debentures. Okay, now let's look at the change in numerator and denominator for this. Now, in terms of options, what will be the change in numerator? I think you already know this, but I'm still putting that question back to you. So in terms of the options, what will be the impact on the numerator? There is nothing. So there will be no impact on the numerator in this case. That's 0. And in terms of denominator, we need to work this out. So let's go back on the denominator. The company has issued 900 options with an exercise price 75, whereas the fair value is 90. Let me just show the workings below. So let's take the case of options. Let's take the proceeds. The company has issued 900 options at the rate of 75. So this works out at 67,500. The proceeds would remain 67,500. And we need to consider they would have been at 90 It would have been, I think, 750 options. That's right. So we can get the bonus element in this. That's right. So we can get the bonus element. So the bonus element in this case is going to be 900 minus 750. That works out at 150. That is the bonus element. So I think we can go back and fit this out here. This is change in denominator 150. That was based on what we did in the previous question as well. Took the numerator change and the denominator change. Now let's go to the next item, convertible preference share. So can I see in terms of the convertible preference shares, what do we add? Dividends, net of tax, without tax. Of course, without tax. So we are given that each preference share is given 9 rupees dividend. I think 7,500 into 9. Let me show the workings out here. 7,500 into 9. And that works out at 67,500. That's correct. And then we also need to consider the change in the denominator. Each preference share is convertible to 2 equity shares. So 7,500 into 2. That's right. So that is 7,500 into 2. That works out at 15,000. So we can now get the incremental EPS, divide the change in the numerator by the change in denominator. It works out at 4.5. So what is the impact of dividend tax? Well, dividend tax now we of course assume it's paid by the company, and in this it's paid by the shareholder. So if it is paid by the shareholder, then I think we are not concerned with that part. So in this particular case, yes, I am given there is a corporate dividend tax. So I guess two views can be taken on this. You can take the view in this particular case that this is paid by the company. If it is paid by the company, then it's an outflow for the company. Since it is given, I think let's add it. Let's add it. So let's add another 8% in this. So let's consider we paid 8%. Okay, not here, sorry. So let's add another 8% out here because we are given, because now as per the new taxation laws, if I rightly recall, I think in this particular case, it is paid by the shareholder. So, but anyway, I think since you pinpointed, we'll take that 72,900. Okay, so this gives me my incremental EPS. Now let's go to the convertible debenture. Convertible debentures is to the extent of 10 lakhs and there is a 10% interest. So numerator is going to be 10 lakhs. The interest is, I think, 10%. Taxes, I guess, 25%. So we take net of tax 75%. And each debenture is convertible into 4 shares. So 10 lakhs is the rupee value, mind you. So can you give me what is the number of equity shares on conversion? Each debenture is 100 each. 10 lakhs is the value. Divided by 100, I guess you get 10,000. That's right. And each convertible into 4 shares, that's 40,000. Correct. So let me put this out here. This is 10,000 into 4. That works out at 40,000. And this is going to be, let's shift it out here. So this is going to be, I think, 10 lakhs into 10% net of tax. That's, I think, 75,000. Right. So we can now calculate the earning per share. So this was 0. Right. So this gives me the incremental earning per share. Now, based on this, we will give the rankings first. I think first we need to give the rankings, then the remarks. Okay, so let's give the ranking. Which one gets a rank 1? Highest or the least one gets a ranking 1? So incremental EPS becomes the basis of ranking. So which one do you give a rank 1? The lowest or the highest incremental EPS? Least the incremental EPS, most diluted it is going to be. So we give a ranking to the options as 1. This gets ranking 2 and this gets ranking 3. Correct. So on this basis, descending to ascending, yes, or we can say the least to the highest. So, okay, we don't need the remarks at this stage. That I'll need later. Okay, so I think the statement of ranking is done. We've taken the change in the numerator, the change in the denominator, got the incremental EPS, which becomes the basis of giving the rank. Now we need to go to the calculations of computation. That is computation of diluted earning per share. The computation of diluted earning per share. Now, I think I already said that. You also know this very well. Are you going to make the adjustment to the numerator in a single go? No. We're going to make adjustments one by one. I always tell people on a very lighter side that the idea of adjusting the, calculating diluted EPS on the base of ranking is, giving an injection to someone. You first insert the injection, he gets a pain. He says, I'm feeling pain. You put more pain to him. So the order of the ranking is going to give a lot of, you can say, dilution, because the idea is to basically, you can say, get the highest dilution possible. So let's make the columns. Particulars, then we can take the numerator, denominator, then we get the EPS, and then we can give the remarks. So this is again a set format which can be used for the calculations. So we'll first start with the basic EPS. Let's go to the numerator back again. So I guess if you look at the numerator, it is 90,000 and the number of shares are 16,000. So 90,000, that is 16,000. We can get the basic earning per share. That's 5.65. Now we'll take the first ranking into account and keep making the adjustments. Options gets the rank 1. So options gets the rank 1. No change in the numerator. 150 is the change in denominator. So what do we get? We get the adjusted numerator and denominator. Can I say this remains at 90? This becomes 16,150. So make the adjustments one by one. Incremental numerator, incremental denominator adjusted, and we get the adjusted numerator, adjusted denominator in this case. So let's again see the calculation. It's 5.5726. Any remarks? Your basic EPS was 5.6 and now its EPS has gone to 5.57. There is a fall. So what do you say? Any remarks? Is it dilutive or is it anti-dilutive in nature? Because as you keep calculating the EPS with the adjusted numerator denominator, we need to give marks as well. And that's right, it becomes dilutive in nature. And because we need to stop the stage where the EPS goes up, we'll stop at that particular stage itself. Okay, let's go further. Now we've got the next one. I think the ranking is convertible debentures. So let's make the adjustments of convertible debenture. The numerator adjustment is 75,000. And I guess the denominator adjustment is 40,000. Let's again get the adjusted numerator. That's, I think, 165. And that's, I think, 56, 150. Let's again get the EPS substantially gone down. So I think this is undoubtedly dilutive in nature. And then comes the third ranking, that is convertible preference shares. So convertible preference shares, I guess this is 72, 900 and 15,000. And this works out at 15,000. Let's get the adjusted numerator denominator again. So we need to consider adjustment one by one. We keep adjusting the numerator and denominator. So this gives me the adjusted figure. Similarly, adjusted denominator. So let's get the EPS, that's 3.34. Now, any remarks at this stage? My EPS compared to the immediate preceding one is actually gone up. So what do you say? Dilutive, anti-dilutive in nature. And that's right, it becomes completely anti-dilutive in nature. So we will not take this into account for the calculation of the diluted EPS. So finally, what will be the answer when I give the diluted earning per share? Can I say it's going to be 2 point approximately 94 if I round it off? I think 2.9, yes, 2.94. That becomes the diluted earning per share. And that was a good question indeed. So we've seen two cases. One is a case of one single potential ordinary share, which was in terms of options. And the other one we've seen is a case of more than one potential ordinary share, where you get the rankings and then you get the EPS. Okay, now we can do something different. This is done. I guess now we can go on to another category of potential shares, I guess. I have a wonderful question. I think we can maybe take that, though it might take a little time. But I think I want to do that because I want to definitely discuss that particular question with you, because that's a beautiful question indeed. So let me share an interesting question. And this is interesting. Let's have a look at question number 8. Now, this is a very interesting question because in this particular case, the issue has been made somewhere in between. So I think at least we'll discuss the main highlights of the question. It came in July 21, examination for 8 marks. This is also one of the, I would say, good questions which have come in the exams. I think let's have a look. So I am given in question number 8. It says on 31st March 2019, the issued capital is 20 lakh ordinary shares. And then it says on 1st July 19, the company issued 25 lakhs 8% convertible debenture. Now the interesting part. So we are given the financial year is April to 31st March. And these convertible debentures, would they be potential ordinary shares? Of course, yes. If they are potential ordinary shares, can I assume that they are issued at the beginning of the year? Or do we assume that they've been issued from 1st of July? So are you going to consider them as a part of the weighted average calculation for the entire 12 months or only for the period July to 31st March? What do you say? Because I think that's one crucial point in this particular case. That's rightly said. So we're going to consider them only from the date they were issued on 1st July till 31st March. Then he says each 100 loan stock may be converted at any time between 24 to 27. And in this particular case, we are given different numbers. So would you also like to tell me what will be the conversion ratio you will assume? We know that the concept of diluted EPS is based on the fact that we always consider the most dilution. So considering that we are going to issue 135 shares or maybe 120 shares, which one do you think we should consider? If I want the highest dilution impact on my EPS, what conversion ratio will you consider in this case? The least, the highest? Because you've given the option to the convertible debenture holder to exercise at a given point of time, and you're giving different numbers. So what do you say? We're going to consider the least number or the highest number in this case? That's right, he said. We're going to consider the highest number because I want the most dilution impact on this. Then he says if the loan stock is not converted by 27, then they get redeemed at par. It is assumed that the equity conversion option is accounted as a derivative liability and is marked to P&L. Because it is a derivative, it will be captured at FVTPL, and then it says the changes in the option fair values are also given. And then further assume that there is no tax consequences arising from these losses. The profit before interest and the fair value movements and the taxations are given. And they relate wholly to continuing operations, so no segregation of CODO, and the taxes 33%, including cess and surcharge. We need a basic and diluted EPS for March 2020 and March 2021. I think let's start working on this. This is one of the excellent questions again. Question number 8. So let me just take you to question number 8 in this case. Now, I guess what I need to do, there are two different years, 1920 and 2021. So let's take a column for 1920. Rather, let's first take a column for 2021 and then take a column for 1920. So I am already given the profit in the question, which is before interest and is before interest, it is before tax and fair value movements. So before interest, fair value movements, and tax. So let's take the figures out here. I guess the information which is given out here is 1790 and 1650. This is 1790. This is 1790 and this is 1650. So I think what we're going to do, first of all, let's take the interest. Now remember, when you're going to take the interest for the previous year is going to be for 9 months. So I think let's take the interest. Can I say the interest in this particular case is, we've got total 25 lakhs into 8%. So let's take 25 lakhs into 8%, and this is going to be 9 months. Current year will be full. So I think this is going to be 2 lakhs. Let's take it in the brackets. And this is 9 months, I think would be 1,50,000. Right, so this is the interest, and then we can also consider the fair value change of the options. So the change in the fair value is given to me, it's 5,300 and 5,000. This is 5,300 and that is 5,000. This is the fair value change for the current year and the previous year. And this is fair value increase. So I think let me take this in the brackets. So this is the fair value change for a liability. So now we can get the PBT. So let's get the PBT. And here also we can get the PBT. Now, quick questions. Are you going to consider the tax on this figure or leaving the fair value change? When you're going to consider the tax, are you going to consider the tax on this figure, or are you going to consider in this particular case leaving the fair value change? What do you say? Because I'm very clearly given in the question that there is no tax consequence on this loss. So that's right. We're going to ignore this particular amount. So let's take 1790 and interest. So let me take the tax is going to be on 15,90,000 into 33% is the tax. So let's see what is the figure of tax. 524,700. This is 524,700. And similarly, this is going to be, I guess, 15 lakhs into 33%. And this is what you gave me is 495. That's correct. So the basic idea was to show you the calculations for a period of interest 9 months. So we'll get the figure. This is, I think, coming to PBT minus this. I think let's manually calculate this. This is going to be, I guess, to the extent of, this is 10 lakh. 15,84,700, 524,700. This, I think, 1060, 10.6 lakhs. That's right. Okay, that's great. So now with this PAT, we are in a comfortable position to get the basic EPS. So we have the weighted average number of equity shares. And I think the weighted average number of equity shares is very clearly given. The very first sentence, it's 20 lakh shares. It's 20 lakh shares. You get the basic earning per share. So this is going to be 10 lakh 60. This is 0.53 and that's 0.5. Right, the basic earning per share is taken here. And now we just need to consider the calculations of the diluted earning. So what do? Add the interest, I guess, net of tax and anything else. If I want to calculate my diluted earning per share, so what all will you add in the numerator? Just the interest net of tax or even the fair value adjustments? What do you say? Because this fair value adjustment is arising out of the derivative financial liability. So in this particular case, do we also make the changes to that as well? What do you say? Just the interest net of tax or also the fair value changes to be reversed? It'll be reversed because now it's gone. So let's take the numerator of the basic EPS. Yes. So this is, I guess, 10 lakh 60. This is 10 lakh 60 and this is 10 lakhs. So we'll take the interest net of tax. Let's add the interest net of tax. So let's see what is the interest net of tax. 2 lakhs into 67%. This is, I think, 134. This is 1 lakh 50 into 67%. I think that's 1 lakh 500. Then you add the fair value change. The fair value change, I guess, was to the extent of this year was 5,300. And that's, I think, 5,000. So this will give me the status of the adjusted numerator for both the years. That becomes the adjusted numerator. And now we can get the adjusted denominator as well. So let's take the denominator. So what is the denominator in this case? It was 20 lakhs. It is 20 lakhs. And we take the increase. So for the latest year, we're going to take what? We're going to issue 135 ordinary shares. So we've got 25 lakhs. 100 is the normal value. So 25,000. So we've got 25,000 debentures. And we're going to give 135 shares each. That works out at 33 lakhs 75. And in this case, do we take 33 lakhs 75 or 9 months? In this case, it would be 9 months because they were not in existence. So that would be 25 lakh 13,250. So with this, we will be able to get the figures as well. That's right, absolutely. So we get the adjusted denominator. So let's get the adjusted denominator in this case. So this will be 53 lakh 75,000. And this will be 45 lakh 13,250. So no, 25, 13, 250 is not correct. I think it's right. Okay, it's 25, 31, 250. I think now it is correct. Yes, you're right. Okay, so let's get the adjusted numerator denominator. So this is going to be, I think, 45, 31, 250. So now we can get the diluted earning per share. We can get the diluted EPS. So this is going to be adjusted numerator divided by adjusted denominator. Adjusted numerator divided by adjusted denominator. Right, so this gives me the diluted earning per share as well. Wow. That was a good question indeed. A lot of calculations, but I think that was a good one on the calculations of diluted earning per share. Right, friends, so our conceptual revisions and the questions on EPS Index 33 done. Now you've got some more questions, which you can definitely try this out. But I think that brings us to things. Concept is very much clear. That's wonderful indeed. So we're going to see you in the next session, friends, for another interesting, I love that standard, Index 12, where we can do some conceptual revisions and do some questions also with you. Eagerly waiting for Index 12. Very clear. Thank you so much. Thank you very much indeed, friends. Thank you very much. And I'm going to see you in the next class on that. Any questions on your side? Right, friends. So I think it's time to say goodbye in that case. Thank you very much. Have a fantastic day as well. Thank you. Bye-bye. Take care. Haji, thank you. Same to you. Thank you.